Hi, welcome back to another edition of Lippers Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'll be reporting flows for the week ended Wednesday, October 29th, 2014. I don't think anybody would be surprised when I tell you that we had positive flows to the conventional fund business, but I think many people will be surprised at how subdued it was considering how strong the performance was. We've actually had positive flows for the last 2 weeks in a row, and this week was really no exception to last week as well. We had really good performance numbers. The Dow actually went over the 17,000 mark, and it was really on good news from third quarter earnings reports and also just strong economic news. And in fact, it continued on throughout the week, except for the last trading day, which was Wednesday on the 29th, that we actually saw subdued performance, and people kind of took a step back after the Fed came back and said, yes, we're going to get rid of quantitative easing. Everybody knew that was going to be the fact. But in their statement, they actually said there might be a chance that they would increase interest rates sooner than the market anticipated. That'll all depend on how the job market looks and inflation looks. And I think that put a little scare into people. Well, let's see how these news actually panned out into the fund flows for the week. Like I said, we saw about $4.7 billion of net new money come into the fund business. And we take a look at the macro group. The equity funds actually took in lost money. They saw about $0.9 billion, $900 million exit their coffers. Taxable bond funds took in some money, $3.9 billion. Muni Bond funds saw a little bit of outflows. It's about $4 million, so really it's zero. It's a rounding issue, very similar to last week that I reported. I think it was $7 million last week. And then we had money market funds that took in about 1.8. So everything was really quite subdued during the week. There really just wasn't a lot of commitment either way, and I think that is just because of how much volatility there has been in the market, and I think that's going to be here to stay. Well, let's see how that panned out actually in the individual equity group. We'll get their breakout right now. About 2.56% return for the week. Like I said, it was a really strong week. That is 2.56%. For a half year is pretty good when you think about the averages between 5 and 7%. But 2.56% for the week. We saw for the second consecutive week actually that we've seen outflows as well. Actually, it's the second week in 3 that we've seen outflows. About $0.9 billion in outflows. And how that panned out, domestic equity funds lost about $800 million. This is the 9th week in 10 that we've actually seen outflows. And then non-domestic funds, we actually saw outflows as well. And this is the second consecutive week we've seen that, but it was just to the tune of about $100 million. It was not that much money leaving. But really, here's where the story was. Large cap funds and mid cap funds saw about equal amount of outflows. They saw about $600 million outflow in the large cap area. Mid cap funds actually saw about $500 million in outflows. So really, that was kind of the story there. Interesting, international equity funds suffered more outflows, about $200 million than their emerging market partners. In fact, the emerging market counterparts actually saw $300 million of inflows. So it's kind of a head scratcher. Again, people finding opportunities to buy in that area, but again, if they were risk on type of focus during the week, which again, why they would do that, I have no idea. Strong flow or strong performance they had, they certainly decided to vote with their feet towards emerging markets and take advantage of that. Let's see how that panned out though in equity ETFs. That's where the exchange was, and my little stumble up front about inflows into equity funds. Well, really, we saw some good inflows, grand inflows. Second week in 3 that we've seen inflows into equity funds, $9.7 billion this week. Spider S&P 500 made up the majority of this new net new money coming in, about $7.2 billion, followed by iShares Core S&P 500 fund. Saw about $900 million in net new money. And at the bottom of the pile, we saw that the Materials Select Sector Spider lost about $1.4 billion, and the Tech Select Spider lost about $900 million out of their coffers. So really it was quite a change from what we saw from the retail side. The only thing we can think of is retail investors have been burned for the last 3 or 4 weeks, and they were just very slow to get back up and running, and they're very cautious ahead of the Fed meeting which took place. And now that the Fed came out and announced that in fact they are comfortable with getting rid of quantitative easing and the economy is doing much better than they had thought, I think investors might start warming up. We'll have to see what the next couple of weeks bring. Well, that brings us to our next group, fixed income group. Let's see what happened on the fixed income market as far as flows goes. Big week, 12th consecutive week we've seen inflows, $3.9 billion. It's the second consecutive week we've had plus side returns, about 0.31%. Good numbers. And how it broke out, we saw corporate investment grade debt funds take in the big chunk, about $2 billion. This is the 26th consecutive week that they've seen inflows, followed by high yield funds taking about $1.5 billion. The second consecutive week they've seen inflows. Again, that's kind of why we were wondering why it didn't happen on the equity side. But nonetheless, as we take a look at it, the area that was a little confounding was that loan participation funds actually witnessed outflows as well, about $400 million in outflows. And again, if you think interest rates going to rise sooner than later, kind of odd that we didn't see any movement in loan pars. This is the 16th consecutive week they've suffered outflows as well. Let's take a look at the ETF side of the fixed income universe to see what happened in their group. Kind of a ho-hum week. We did see about $2.5 billion enter their markets via this instrument, and it was the fourth consecutive week that we've seen inflows into this. How it broke out, though, is at the top of the group we saw iShares short Treasury bond ETF taking about $1 billion, and at the bottom we saw PIMCO Enhanced Short Maturity ETF lose about $300 million. Again, it wasn't that big a week to talk about. Anytime you get in the billions though on the fixed income fund, it's worthy to take note that investors are putting that type of money back to work on the fixed income side. Let's take a look now on our Muni Bond Fund flows. Muni Bond Funds actually lost, again, a little bit of money, about $4 million. Second consecutive week we've seen outflows. Last week it was $7 million. This week it was $4 million. These could be rounding errors for all that's concerned with that when we get down to the millions. It's the second consecutive week, though, that we've actually seen negative performance, but this one, 0.03% on the negative side. Again, kind of a ho-hum week. Interesting, though, if we take a look, national munis actually took in about $79 million. That means that the single state munis had to lose somewhere around 82, 83, 84 million to offset that and actually bring us into a negative territory of $4 million. So again, people have been putting money to work in the national munis, taking money out of the single states. That's been a kind of an ongoing story we've been talking about over the last several months. Now let's take a look at what happened to money market funds. Money market funds for the second consecutive week actually saw inflows, this time only $1.8 billion. It's been kind of on the low side. We've been seeing some big multiples on the money market side, either in or out. This time we just saw about $1.8 billion in inflows. How that broke out. Taxable money market funds actually experienced $4.5 billion net new money coming into their coffers. And how that was broken out, institutional investors put away about 12.3 into that group, while retail investors took out about 7.8 billion. So that brought us to our net of 4.5, and then we get to the tax-exempt money market funds, and we saw one of the bigger outflows from this group that we've seen in a while, $2.7 billion in outflows from the tax-exempt money market fund group. So that's kind of the quick snapshot over the week on all those groups. Now, as we look at the news last night and today, we see a couple of things. First of all, we all heard that third quarter GDP growth actually came in much higher than expected, 3.5% versus 3%. I think that's going to be a boon for equity investors and maybe even for fixed income investors. Who knows? But maybe the bigger story, and this is why fixed income investors might benefit as well, is the Bank of Japan announced late last night, early this morning our time, basically that they are going to do more quantitative easing, and they're going to throw everything, including the kitchen sink, at this problem, and they're going to go out and buy bonds. They're going to get down already in negative numbers as far as interest rates go, but they're going to be very aggressive about this, and this really has propped up the market today. We're in new territory for the Dow again, record-breaking areas for the Dow. Will hopefully finish up that way, and I think that will impact what we see and what we do next week. Well, if you wanted to do a deeper dive, and I didn't cover some of the areas that you wanted to take a look at, you can go to our site, www.lipperusfundflows.com. If not, you can join us next week when one of our analysts will talk to you about the flows trends for that week. Until then, my name is Tom Rosine, wishing you the best in your wealth planning and creation. Thanks for joining me.